Good evening, everybody. Uneducated economist here. So I was reading a pretty good article coming out of Seeking Alpha earlier, and this article was talking about the public and private reserves in the banking system, and how prior to the financial crisis, it was pretty much private reserves that had filled the needs of the liquidity for the banks. After the quantitative easing and the Federal Reserve's efforts, it was the public reserves that was filling the liquidity needs of the banks. So the quantitative tightening. This is when the Federal Reserve attempted to pull some of that liability out of the system, their cash, the liquidity, right? They wanted to see where the demand for their liabilities was. And they found it almost right away. As they started to return to normalcy, right, whatever that was, I don't think they ever thought that they would ever get back to where they were prior to the financial crisis, but I figured that they probably thought they would get a lot farther than they did. But then they found that the demand for their liquidity, the demand for cash was huge, and they had to step in with that repo market to start filling the bank's need for liquidity. So what happened here? Back in 2008, there was a huge drawdown in cash. Money markets were, remember the money market, huge drawdown in the money markets, and they had to freeze all the banks up. They had to step in with liquidity and start, filling the bank's need for loaning on an overnight basis to get the economy moving again. This was like we were at the abyss. We were about ready to go off a cliff. But luckily, the Federal Reserve, with all their liquidity, filled the needs of the banks and were able to get loans starting to move again. Here's the thing. As they started to pull that liquidity out, okay, to try and see how much demand for the liquidity there was out there, seeing where it was in the private sector as far as filling the need of the liquidity. And they found that is almost none there. The private sector is not providing the liquidity that they were anticipating. See, they were thinking they could return to somewhat of a normal. They didn't even come close. So where's all this liquidity? Well, you think about this for a second, and you think about how much shadow banking takes place. All that is based on how much liquid is actually in the market, how much currency there is, or how much cash, how many liabilities from the Federal Reserve. Because all that shadow banking, even though it's written on contracts, all of that stuff is due in dollars. All that is not part of the Federal Reserve's model. They don't look at that as part of the issue. See, that's a huge problem. Bonds outside of the country were written in US dollars. China issued out a ton of corporate bonds that are due in dollars. The demand for dollars is huge. As they have weakened their currency, it takes ever more of their currency to come up with the dollars that they need in order to pay these bonds. These bonds are starting to default. Places like Venezuela, whose currency has gone through hyperinflation, their citizens there do not use their local currency, they use US dollars. And their banking system doesn't allow them to deposit US dollars in the bank, so now crime runs rampant because everybody knows everybody has cash in their pockets. This is not part of the Federal Reserve vision. They do not see this. The demand for cash across the world is going to get huge as the economy continues to slow down. Everybody's wanting to get into the safe haven asset. Whether it's negative interest rates that are forcing you to do it, or you're going through some serious bad times like in Venezuela, the demand for cash is going to be huge. This is one of the reasons why I am such a strong dollar advocate, is for this very reason. At some point, people are going to get nervous and they're going to want to cash out. And there is just simply not enough liquidity out there for everybody to do it. That's going to be a huge problem. Can the Federal Reserve print at a pace that is fast enough to meet the needs of the entire world demanding cash? And then at what point does that demand end and then reverse, where they no longer want the cash? See, these are the things you got to think about. These are the things that are taking place right now. See, a lot of people want to point at a particular institution, or something like that. It's not. It's a much bigger, broader picture. It has to do with a lot more than that. It has to do with, the rich elite cashing out. It has to do with places like Venezuela getting into cash. Places to do with like China with their bonds. It has to do with the entire world demanding dollars. It's a very serious issue. It's not just here in the United States that we have to look at. It's the entire world who uses our currency. And they don't have to. And at some point, if we have got ourselves to a point where there's too many dollars in the system and the world doesn't want them anymore, how do you deal with that? As those dollars start to come back to the United States, as we will be the only place that will accept them. See, these are the things that I think about. Anyway, interesting stuff. I'll leave a link down in the description. Uneducated Economist. You guys let me know.